Historical data is important, right? We want to be sure that we can put things in perspective and also use it for guidance going forward. So we can adjust our decisions, adjust our perspective based on what has happened previously. Of course, we don't want to be driving using the rear view mirror only, but I think data that lags, which all data must, especially from an economic standpoint, it really can help us when it comes to understanding things and also using it in terms of our own real estate investing. So today, I wanted to compare 2001 and 2008 and 2020, and this is going to be a two-part series because there's a lot of information here, there's a lot of economic data points, and there's a lot of key takeaways, and I don't want to rush it. So today is part one of this two-part series. We're going to talk about 2001 and then 2008, if we have time, and then during volume 2, we'll talk about 2020 and kind of tie it all in together. So in 1999, the economy seemed to be heating up and the stock market was going on a bit of a tear. And so the Fed, in an attempt to curtail this, started raising interest rates. That's right. I said the Federal Reserve was raising interest rates. In fact, the Fed made 6 consecutive raises between June of 1999 and May of 2000. Now, in March of 2000 is when the stock market bubble burst. To put things in perspective, the stock market fall was really focused on the NASDAQ when the dot-com bubble burst. And so the Dow Jones wasn't really that impacted until 9/11 happened, which is obviously September 11, 2001. Now, the National Bureau of Economic Research, usually written as NBER, estimates that the recession began of March of 2001. From there, due to the 1-2 punch of the NASDAQ bubble and then the September 11th, the bear market was very long, at least from the stock market's perspective. It was actually 43 months to go down about 34% across the S&P 500. Of course, we're going to talk about 2020 soon, but compare this to just about a month in which the U.S. stock market lost about 30% of its value during this coronavirus pandemic, or at least concerned about the pandemic. Now, keep in mind, that's the stock market, not the general economy. So for clarification, the economy did have about 8 months of negative economic growth, but the stock market fell 34% over a 43-month period. It took about 4 years to recover back to its pre-crisis levels. Now, here's something interesting, though. Home prices actually increased during the recession on a national level. Yes, of course, there were some markets that experienced price corrections, but for the most part, sales volume either slowed down significantly, and then everyone kind of paused and waited and then said, okay, great, that's happened. This is fine, but didn't really experience a lot of negative price deflation. And then it started picking right back up again. So for example, in California, prices increased significantly in 2000, 2001, and 2002. I'm talking like 5% or more each year. Now, something else I thought noteworthy about this was that the prices never came down to their 2001 levels again. So let's say that it's 2000 and you're really bearish on the stock market. You think that the dot-com bubble is about to burst and you say, hey, I'm going to wait here at these levels, these 2000, 2001 levels, and as soon as there's a 10% discount to these 2000 prices, I'll buy a property. So you put your foot in the ground, say, as soon as there's a 10% discount to these prices right here, right now, I'll buy a property. Well, the recession came, as you might have predicted, but that real estate correction didn't really even take a breath, let alone turn into some negative prices. And so what you would have missed out on is the opportunity to buy. This brings up an important point because we discussed on the program before, recessions and real estate price corrections are not really correlated with one another. Most recessions do not result in real estate price corrections. In fact, there aren't many examples of widespread real estate price corrections. Of course, we're going to talk about one in 1 second, but not something to make a bet on. Now, as far as general economic data, unemployment rose from about 4.2% in 2001 to 5.5% in November of 2001, but it continued to rise all the way to 2003, where unemployment peaked out at about 6.3%. Now, in this time, jobless claims peaked at about 421,000. Now, remember that number for later. Some of you might know where I'm going with this. So that jobless claims number was 421,000. Generally speaking, the 2001 timeframe was a very tame recession. And if you didn't have exposure to NASDAQ, and if you weren't really exposed to the dot-com bubble, you might have felt like it was pretty much business as usual. Of course, there were sectors of the economy that were hit very hard. The airlines industry, for example, travel generally, but specifically the airlines industry were hit very hard in the wake of 9/11 of 2001. But the economic impact wasn't really felt through the entire economy, at least not in the US economy. Now, in 2008, many of you might be old enough to remember this, and you may have even been participating to some degree in the real estate market. But it's very important to look back on this and put things in perspective. To put it bluntly, the IMF considers 2008 to be one of the most devastating and severe financial meltdowns since the Great Depression. There was a lot that was unique about 2008, one of which is that the recession was initiated by one of the most significant housing crashes in US history. The downturn technically lasted 19 months compared to the 8 months of the 2001 correction. And as you probably know, the Fed implemented really unprecedented measures, including massive bailouts of private companies, bailing out entire sectors of the economy. Most of it will be real estate and the banking sector and the US car manufacturers. Unemployment jumped from around 5% in 2007 to 10%, which is actually a 30-year high. Now, at that time, we saw jobless claims get up to a peak at around 665,000 or so. And again, looking at this on the historical data chart, you can see that that 665 number is very high historically. Again, there's a lot of things that make 2008 special. It was a global economic crisis that was widespread in virtually every developed nation in the United States. China was a developing nation in particular and didn't really feel a lot of the pain that a lot of us did. Most importantly, it was a challenge with debt. Anytime there is a correction where debt is the underlying factor, things get nasty really quickly. There was a lot of leverage that companies had, that households had, that governments had. And when there was a significant correction to the asset values of those underlying debts, obligations, there was a massive liquidity crunch. And so we saw a spiral of sorts where there was liquidity crunch, which resulted in the seizing of assets and selling it on pennies on the dollar, which then, of course, reduced the prices of these other assets. And there was a massive deleveraging that took place, again, in households and companies and governments. Now, I don't want to misconstrue the fact that deleveraging and saying that governments were deleveraged in 2008 is not at all what happened. In the US, for example, you saw trillions of dollars of debt be created. Now, again, to get back to housing, one of the big stories in the US was foreclosures, which jumped from about 100,000 a month to more than 350 per month, more than a 350% increase, which had never been seen before. And that 350,000 per month was happening month after month after month. Housing prices took about 6 years to recover from their pre-crisis lows. Some markets like Los Angeles took nearly 11 years. So very much an anomaly. As far as the stock market is concerned, the S&P, the Dow, fell about 49% in a 16-month period and took about 4 years to recover from its pre-crisis highs. Now, there have been a couple of guests on the show which have talked about the fact that stocks tend to move more quickly than real estate. Obviously, that's common. But if you have an interest in participating in the stock market, the argument could be made that if there's a massive correction in both stocks and real estate, which is not typical, but if there is one, that the argument can be made that you can invest in the stock market, experience gains, sell after you believe that those gains had been created, and then buy real estate prior to real estate correcting. And this is certainly true of 2008. If you bought stocks in 2009, sold them in 2012, and bought real estate in 2012, you would be looking like a total genius right now. And I have a theory that that's not going to present itself as an opportunity very frequently, just because there isn't a lot of negative real estate years that we have on record. But if it does happen, I will certainly be looking at that strategy, not for my entire portfolio, but let's say the amount of money that I might have invested in 2 real estate deals, something like that. I could definitely see that being something. All right, now this is just part 1. So we're going to talk about this over 2 volumes. So that's part 1 here. In the next episode, we'll talk about part 2, which is the 2020 crisis, and comparing all of these together. All right, hope you enjoy it. All right, listeners, you know the routine. This show is all about learning, making wise investments, and protecting and growing your capital. So if you're interested in these topics, make sure to hit the subscribe button. Of course, if you've already enjoyed a couple of great episodes, don't be shy, leave a review. It really helps the show's visibility. And lastly, if you're an accredited investor and you're interested in learning more about our investment opportunities, the types of deals that I personally invest in, go to asymcapital.com. That's ASYMcapital.com. Thanks a lot.